Friends, thank you for being here today. What if I told you that we are living through a housing shortage so severe that immigration has hit record levels, yet developers are canceling thousands of homes because they physically cannot sell them? What if the crisis isn't a lack of supply, but a mathematical impossibility where the cost to build is higher than the price anyone will pay? I want you to consider a number: 24,045. That's the number of brand new condominium units sitting empty right now in the greater Toronto Hamilton area. Not homes waiting for tenants, not properties under construction. These are finished buildings, towers with elevators, lobbies, and mailboxes, standing completely vacant because no one can afford to close on them. At an average price of roughly $800,000 per unit, we're looking at $19 to $20 billion in paralyzed capital, locked inside concrete and glass, generating nothing but maintenance fees and property taxes that are bankrupting the developers who built them. This is not a market correction. This is not a cooling period. This is a liquidity seizure, a structural fault line in the foundation of Canadian real estate that is about to expose who has been swimming naked as the tide goes out. Let me give you the second number that makes this inevitable: 102%. That's how much the inventory of completed but unsold condos has increased in just 1 year. These aren't units that are taking a little longer to sell. These are what I call ghost towers, finished buildings that have mathematically failed before a single resident moves in. And here's what makes this a singular inevitability rather than a temporary problem: the negative spread. The average pre-construction condominium unit in Toronto costs $1,187 per square foot to purchase from a builder. But the moment that building is finished, the resale market value is only $903 per square foot. That's a gap of $284 per square foot. On a typical 600 square foot unit, that's $170,000 of instant, unavoidable loss the second you sign the closing papers. Think about what this means. Every single buyer who put down a deposit in 2021 or 2022, banking on appreciation to carry them through to closing day in 2025, is now facing a choice: come up with nearly $200,000 in cash to cover the difference the bank won't lend on, or walk away and lose your deposit. Most are choosing the latter. And when they walk away, the developer gets the unit back. But the developer can't sell it either, because their construction loan legally requires them to sell at the original price of $1 million, not the market price of $800,000. This is the inventory deadlock. Buyers can't buy because the math destroys them. Sellers can't sell because the banks won't let them drop prices. And so the entire market freezes, waiting for someone to blink first. Now, you might be asking yourself, how did we get here? How does a country facing a historic housing shortage end up with developers canceling 21 massive projects representing over 4,400 units because they can't find buyers? To answer that, we need to go back to the genesis of this crisis, not to last month's headlines, but to the decisions made in 2020 and 2021 that set this mathematical endgame in motion. It starts with what I call the zero rate mania. When the Bank of Canada slashed interest rates to near zero during the pandemic, it created a very specific kind of delusion in the minds of real estate investors. They looked at pre-construction condos, units that wouldn't be finished for 3, 4, sometimes 5 years, and they ran a simple calculation. They assumed that by the time the building was complete, prices would have appreciated enough to cover their negative cash flow, their closing costs, and still leave them with a profit. They were buying air. They were buying time. They were buying the assumption that tomorrow's market would bail out today's bad math. But that assumption rested on a foundation of sand. It required rates to stay low. It required prices to keep climbing. It required banks to keep lending at 90% loan to value with no questions asked. And when the Bank of Canada raised rates 11 times in 18 months, that entire scaffolding collapsed. Here's the mechanism that is destroying these deals. And I want to explain it simply because this is what I call the big secret of the entire system. The thing that determines whether you close on your condo or lose everything. It's called the appraisal gap trap, and it works like this. You sign a contract in 2021 to buy a condo for $1 million. You put down $50,000 as a deposit, 5%. The building is scheduled to complete in 2025. Fast forward to today. The building is done. The developer calls you and says it's time to close. You go to the bank to get your mortgage. But here's the problem. The bank doesn't care what you agreed to pay in 2021. The bank cares what the unit is worth today. And today, in 2025, the bank's appraisal comes back at $800,000. So now you have a choice. The bank will lend you 80% of $800,000. That's $640,000. But you owe $1 million. The difference, $360,000, has to come from you in cash immediately. You don't have it. Almost no one has it. So you default. You walk away. You lose your $50,000 deposit, but losing $50,000 is better than finding $360,000 you don't have. The developer gets the unit back. But now the developer has a worse problem. They can't sell that unit for $800,000, even though that's the market price, because their construction lender, the bank that funded the building, has a covenant in the loan agreement that says the developer must sell units for at least $1 million, or the bank can declare the loan in default and seize the entire building. So the developer is trapped. They can't lower the price without triggering a bankruptcy. They can't hold the price without bleeding to death on interest payments and maintenance fees. And so the unit sits there empty, part of the 24,000 unsold units accumulating across the greater Toronto-Hamilton area like financial cancer. This is not a problem that solves itself with time. This is a problem that metastasizes. Now, let me show you the evidence that this rot is already spreading, because we're not talking about theory anymore. We're talking about named casualties, specific towers, real bankruptcies happening in real time as I speak to you today. The first canary in the coal mine is a building you may have heard of. It's called The One. It was supposed to be Canada's tallest residential building. 85 stories of luxury condos in the heart of downtown Toronto, designed by a celebrity architect, marketed to the global elite. The developer, Mizrahi Developments, poured everything into it. And today, that building sits in receivership with $1.7 billion in debt. $1.7 billion. It is not a building anymore. It is a monument to insolvency. A physical reminder that when leverage exceeds reality, even the tallest tower falls. But The One is not alone. There's Vandyk Properties, a mid-sized developer that built a reputation on pre-construction townhomes and condos across the greater Toronto area. Over the past 18 months, Vandyk has had at least 5 major projects placed into receivership, with debts exceeding $200 million. Projects like Uptowns in Vaughan, Heart Lake in Brampton, buildings that were supposed to deliver thousands of homes to a market desperate for supply, are now frozen in legal limbo while creditors fight over the carcass. And then there's 260 High Park, a boutique project where a historic church was converted into condos. It stalled mid-construction, went into receivership, and left buyers waiting years, not to move in, but just to get their deposits back. Some still haven't. These are not isolated failures. These are symptoms of a contagion, and the contagion is spreading because the people who funded these projects, who lent the money to build them, are now trapped too. Let me introduce you to a term you need to understand: the shadow lenders. These are the private mortgage funds, the mortgage investment corporations, the high net worth family offices that stepped in when the big banks said no. They lent billions of dollars to developers at 10, 12, sometimes 15% interest, secured against buildings that were supposed to be sold and refinanced within 2 or 3 years. The plan was simple. The developer borrows from the private lender to build the tower, sells the units, and then a big bank steps in with a permanent mortgage to take out the private lender. The private lender gets repaid with interest, and everyone walks away happy. Except the big banks aren't stepping in anymore. They're looking at these buildings and saying, the units aren't selling. The appraisals are underwater. We're not lending on this. And so the private lenders, who were supposed to be temporary bridge financiers, are now stuck holding permanent loans on depreciating assets, bleeding interest, facing redemption requests from their own investors who want their money back, and realizing there is no exit. This is what I call the shadow ledger, the ocean of private debt that doesn't show up on the big banks' balance sheets, but is drowning developers, investors, and lenders all the same. And when that ledger collapses, it doesn't just take down the developers, it takes down the contractors who haven't been paid, the suppliers who shipped materials on credit, the real estate agents who earned commissions on units that never closed, and the municipal governments who were counting on development charges and property taxes that will never materialize. Friends, we are not watching a correction. We are watching the unwinding of a decade-long bet that real estate only goes up, and the unraveling has already begun. Now let me show you the trigger event that turned this from a slow bleed into a hemorrhage. In the third quarter of 2025, new condominium sales in Toronto hit a 35-year low. Not since 1990, before the internet, before smartphones, before most of you watching this were born, have we seen sales this catastrophically low. And here's the number that should terrify you. Sales dropped 88% below the 10-year average. This wasn't a slowdown. This was a full stop. The market didn't cool. It froze solid. But understand what this means in practical terms. When sales collapse by 88%, it's not because people don't want homes. It's because the financial architecture that allows people to buy homes has broken. The mortgage market, the appraisal system, the builder financing model, all of it depends on a continuous flow of transactions. When that flow stops, the entire machine seizes up like an engine running without oil. And here's where it gets worse. There are 31,422 condominium units scheduled for completion in 2025. Think about that. Over 31,000 units, all needing buyers, all needing mortgage approvals, all needing to close within the next 12 months. Every single one of those units represents a developer who needs that sale to pay back their construction loan, to pay their contractors, to avoid default. And every single one of those buyers needs to qualify for a mortgage on a property that may already be underwater before they even get the keys. This is force number one of what I call the convergence, the moment when multiple structural failures hit at exactly the same time, creating a crisis that cannot be managed with the normal tools of monetary policy or government intervention. The inventory tsunami is already here. It's not coming. It's not theoretical. Those 31,000 units exist. They're finishing right now, and there aren't 31,000 qualified buyers waiting to purchase them. Force number two is what I call the investor exodus. And this is where human psychology collides with mathematical reality. Remember, the bulk of pre-construction purchases in 2020 through 2022 were made by investors, not end users. These were people treating condos like stocks: buy low, hold for 3 years, sell high at completion. They never intended to live in these units. They intended to flip them. But flipping only works when prices go up. When prices go down, you're not an investor anymore. You're just someone holding a losing position. And so investors are walking away. They're forfeiting their deposits, $50,000, $75,000, sometimes $100,000, because they've done the math and realized that closing on the unit would cost them $300,000 they don't have. Walking away from a $100,000 deposit sounds insane until you realize the alternative is losing $300,000. At that point, walking away is the rational choice. It's financial triage. But here's the cascading effect that most people don't see. When an investor walks away from a pre-construction contract, the developer doesn't just lose that sale, they lose the cash flow they were counting on to make their next interest payment. They lose the velocity they need to keep the project moving. And because these developers are often leveraged across multiple projects, the failure of one building can trigger margin calls and covenant breaches on completely unrelated properties. This is what I call receivership contagion, the spreading collapse from one developer to their lenders, to their contractors, to their suppliers, until entire ecosystems of construction finance begin to implode. And that brings us to force number 3, the shadow debt. I mentioned earlier the private lenders, the mortgage investment corporations, the family offices lending at double-digit interest rates. These lenders are now facing what's called a redemption run. Their own investors, pensioners, retirees, people who thought they were earning safe, high-yield income, are looking at the headlines about receiverships and developer bankruptcies, and they're demanding their money back. But the lenders can't give it back because their capital is locked inside half-built towers and unsold inventory that can't be liquidated at any price. Let me explain how bad this gets. A typical MIC might have lent $200 million across 20 different condo projects. On paper, those loans are secured by real estate, so they look safe. But in reality, if even 3 or 4 of those projects fail, the MIC doesn't have enough liquid reserves to handle the redemptions. They have to halt withdrawals. They have to suspend payments. And when word gets out that a MIC has frozen redemptions, it triggers panic across the entire private lending sector. Other MICs see their own redemption requests spike, and suddenly the liquidity crisis that started with unsold condos spreads into the shadow banking system that funds them. This is the trifecta I warned you about at the start: the inventory tsunami, the investor exodus, the shadow debt implosion. All 3 forces are converging right now in real time, and they're feeding off each other in a doom loop that has no natural bottom. Now you might be thinking, okay, this sounds bad, but governments will step in, central banks will cut rates, regulators will provide relief, and you're right that they'll try. But here's what you need to understand about why this crisis is different from every other real estate downturn you've lived through. In a normal correction, prices fall, buyers step in to take advantage of lower prices, and the market clears. Supply meets demand at a new equilibrium. But this is not a normal correction. This is what I call negative leverage, a situation where the asset itself is burning more cash than it generates, regardless of the price. Let me show you what I mean. Imagine you're a developer holding one of those 24,000 unsold units. Every month that unit sits empty, you're paying property taxes, maintenance fees, and interest on the construction loan. Let's say that's $3,000 per month in carrying costs. If you're holding 200 unsold units, that's $600,000 per month in negative cash flow with zero revenue coming in. At that burn rate, you're insolvent in 6 months, no matter what the Bank of Canada does with interest rates. Now, you might think just drop the price and sell the units. But remember the appraisal gap trap I explained earlier. If you drop the price below the construction loan covenant, the bank seizes the building. If you hold the price, no one buys. You're in a vice, and the vice is tightening every single day. And here's the counterintuitive part that most people miss. Even if the Bank of Canada cuts rates by 1%, even by 2%, it doesn't fix this problem. A rate cut makes future mortgages cheaper, but it doesn't erase the $200,000 appraisal gap that exists today. It doesn't put cash in the hands of investors who already walked away. It doesn't make the 31,000 incoming units disappear. The crisis is structural, not cyclical, and you cannot solve a structural crisis with cyclical tools. This is the moment where I need to talk about your psychology, because the greatest danger right now is not the market, it's your own mind. Human beings are hardwired with something called normalcy bias. It's the assumption that tomorrow will look like yesterday, that systems which have always worked will continue to work, that crashes happen to other people in other places, but not here, not now, not to you. And I understand why you feel that way. Canadian real estate has been a one-way bet for 20 years. Every dip has been followed by a recovery. Every crisis has been solved by government intervention or central bank liquidity. The idea that this time could be different feels like paranoia. It feels like doom mongering. But, friends, the mathematical reality doesn't care about your feelings. The appraisal gap doesn't care that you've been told real estate always goes up. The construction loan covenant doesn't care that you believe prices would appreciate. There's a second psychological trap you need to be aware of, and it's called the sunk cost fallacy. Right now, there are thousands of pre-construction buyers sitting on contracts they signed in 2021, watching the market deteriorate, knowing they're going to lose money, but holding on anyway because they've already invested so much, emotionally, financially, psychologically, that walking away feels like admitting defeat. But here's the truth. The deposit you already lost is gone whether you close on the unit or not. The question is not, how do I get my deposit back? The question is, do I compound my loss by pouring another $200,000 into an asset that's depreciating? And for most people, the answer is no. But they won't accept that answer because it means admitting they were wrong, admitting they got caught in a mania, admitting they bought at the top. Let me give you a framework for understanding what's really happening here, because this is not just about Toronto condos. This is about the transition from what I call paper wealth to mathematical reality. During the zero rate era, asset prices became untethered from their fundamental value. People became millionaires on paper. Their net worth skyrocketed because their condo, their stock portfolio, their crypto wallet showed numbers that made them feel rich. But that wealth was an illusion. It was a function of liquidity, of credit expansion, of other people being willing to pay higher and higher prices for the same assets. And now the liquidity is draining, the credit is contracting, and we're discovering that the wealth was never real. It was just a number on a screen, backed by nothing but the assumption that someone else would pay more tomorrow. This is what I call the money illusion. You became a millionaire on paper, but you're poorer at the grocery store. Your net worth went up, but your purchasing power went down. And now, as the market reprices, the illusion is evaporating, and what's left is the hard reality of debt, obligations, and assets that no one wants to buy. So let me ask you the question that should be keeping you awake at night. When the liquidity tide goes out, when the paper wealth evaporates, when the appraisal gaps become unavoidable, what are you left holding? Are you holding assets, or are you holding claims on assets? Are you holding something real, something scarce, something that cannot be created by a central bank or a developer's printing press? Or are you holding a 600 square foot box in a 40-story tower surrounded by 23,000 other identical boxes, all competing for the same shrinking pool of buyers? This brings me to the final and most critical question. What do you do now? Because everything I've shown you so far is diagnostic. I've shown you the disease. I've shown you how it spreads. I've shown you why the normal treatments won't work. But diagnosis without prescription is just intellectual entertainment. And friends, we are past the point of entertainment. We are at the point of decisions that will determine whether you preserve wealth or watch it vanish in real time. Let me be very clear about what is coming next, because the window for preparation is closing. We are entering a phase I call the Great Repricing, a period where every asset class that was inflated by cheap credit gets marked down to its true unlevered value. And that repricing is going to be violent, disorderly, and punishing to anyone caught holding the wrong assets. Here's what that looks like in practical terms. Those 24,000 unsold condos I mentioned, they're going to sell eventually. But they're not going to sell at $1 million. They're going to sell at whatever price clears the market. And based on the current appraisal gap, that means discounts of 20, 30, maybe 40% from peak prices. Now, you might think that's good news for buyers. Cheaper prices mean more affordability, right? Wrong. Because here's what happens when distressed inventory floods the market. It doesn't just affect the unsold units, it affects every comparable unit in the surrounding area. If a developer in receivership is forced to sell units at $700,000, then every owner who bought at $1 million just lost $300,000 in equity overnight. Their net worth evaporates. Their ability to refinance disappears. Their retirement plan, which was based on selling that condo and downsizing, just got cut in half. And it cascades. The owners who are now underwater stop spending. They cut back on renovations, on furniture, on discretionary purchases. The businesses that depend on those purchases start laying off workers. The workers who lose their jobs can't pay their mortgages. Defaults rise. Banks tighten lending standards further. Fewer people qualify for mortgages. Demand drops even more. Prices fall further. And the doom loop accelerates. This is not hypothetical. This is the playbook from every real estate crisis in history, from Japan in the 1990s to the United States in 2008 to Spain and Ireland in 2012. The only question is not whether it happens, but how fast and how deep. Now, let me address the argument I know some of you are making in your heads right now. You're thinking, but Canada has immigration. We have population growth. Demand is structural. This can't be like Japan or the US because we actually need more housing. And you're right that Canada has a housing shortage. But here's the paradox you need to reconcile. You can have a shortage of affordable housing and a surplus of unaffordable housing at the exact same time. Those 24,000 unsold units, they're not sitting empty because nobody needs a place to live. They're sitting empty because nobody can afford to close on them at the prices required to keep the developer solvent. The units exist, the demand exists, but the financial bridge connecting them has collapsed, and no amount of immigration can fix an appraisal gap. No amount of population growth can make a buyer come up with $200,000 in cash they don't have. This is the structural contradiction at the heart of the crisis. We are canceling thousands of units, not because we don't need them, but because the math of building them has broken. The cost of construction, driven by land prices, labor costs, material inflation, and development charges, has risen so high that the final product is unaffordable to the very people who need it most. And so we get ghost towers, buildings that exist but cannot be lived in, inventory that sits vacant while people sleep in shelters, supply that cannot meet demand because the pricing mechanism itself has failed. And here's what makes this unsolvable with traditional policy tools. If the government steps in and subsidizes buyers to close the appraisal gap, they're essentially bailing out developers and investors who made bad bets with cheap money. If they let the market collapse, they risk a cascade of bank failures, pension fund losses, and a broader economic contraction. Either choice is politically toxic. Either choice creates moral hazard. And so they will do what governments always do in these situations. They will delay, they will extend, they will pretend until the market forces their hand. But you don't have to wait for the government to decide. You can make your own decision right now based on the information in front of you. And that decision comes down to a binary choice that I need you to understand clearly. On one side, you have what I call depreciating inventory. This is paper assets, stocks, bonds, ETFs, mutual funds, and yes, condominiums, whose value is a function of market sentiment, liquidity conditions, and the collective belief that someone else will pay more tomorrow. These assets can evaporate overnight when confidence breaks. They can be diluted by central bank money printing. They can be confiscated by capital controls or wealth taxes. They exist in the financial system, and when the financial system breaks, they break with it. On the other side, you have scarcity. This is physical assets that cannot be printed, cannot be created by a developer's blueprints, cannot be inflated away by monetary policy. I'm talking about land, not condos, not subdivisions, but actual scarce land in locations where supply is genuinely constrained. I'm talking about gold and silver, monetary metals that have preserved purchasing power through every currency crisis, every sovereign default, every hyperinflation in recorded history. Now, I know what some of you are thinking. Gold doesn't pay dividends. Land doesn't generate cash flow. Why would I hold something that just sits there? And that question reveals the mindset that got us into this crisis in the first place. The assumption that assets must always be productive, always generating yield, always working for you. But friends, in an environment where the entire financial system is built on leverage, and that leverage is unwinding, the goal is not to maximize return. The goal is to not lose everything. Let me put it this way. Would you rather own a claim on an asset or the asset itself? Would you rather own shares in a real estate investment trust that holds mortgages on condos in Toronto? Or would you rather own an acre of land that nobody can build more of? Would you rather own a paper certificate that says you own gold stored in a bank vault somewhere? Or would you rather hold the physical metal in your possession where no counterparty can default on their obligation to deliver it? This is not about investment returns. This is about stepping out of the line of fire, because when the repricing comes, when the illusion of paper wealth collapses, the people who survive are the people who are holding real things that have intrinsic value independent of the financial system's continued functioning. And let me be very specific about gold and silver, because this is where the transition from illusion to reality becomes most clear. Gold is not an investment. Gold is insurance. It is the asset you hold when you no longer trust that the pieces of paper in your wallet or the digits in your bank account will hold their purchasing power. It is what you own when you understand that every fiat currency in history has eventually been debased to zero, and that the current system, built on infinite debt expansion and central bank balance sheet explosions, is no different. Right now, as I'm speaking to you, central banks around the world are buying gold at record levels. China is buying gold. Russia is buying gold. India is buying gold. These are not speculative trades. These are strategic moves by sovereign nations who understand that the dollar-based system is in its terminal phase, and that when the reset comes, the countries holding hard assets will have leverage, and the countries holding treasury bonds will have worthless paper. You can dismiss that as conspiracy theory if you want. You can call it doom mongering. But I would ask you this: why are central banks buying gold if it's just a barbarous relic? Why are they repatriating their gold reserves from foreign vaults if there's no risk to the system? Why are they diversifying away from dollars if the dollar is as safe as we're told? The answer is because they see what's coming. They see the debt spiral that has no mathematical solution. They see the pension obligations that cannot be paid. They see the entitlement programs that will bankrupt nations, and they are preparing. The question is, are you? Now, let me bring this back to Toronto, because the condo crisis is not a standalone event. It is a microcosm of the larger transition happening across the entire global economy. What you're seeing in those ghost towers, the inventory deadlock, the appraisal gap, the negative leverage, the shadow debt implosion, is the same dynamic playing out in commercial real estate, in sovereign bonds, in pension funds, in every corner of the financial system that was built on the assumption of infinite growth funded by infinite credit. And when that assumption breaks, when the liquidity drains, when the paper wealth evaporates, the only things left standing are the things that have value independent of the system: land, commodities, precious metals. These are not relics of the past. They are the foundations of the future, because they are the only assets that cannot be conjured into existence by a keystroke or a printing press. So here is my final question for you, and I want you to sit with it. Do you want to own something that depends on confidence, or something that exists whether you believe in it or not? Do you want to own a liability disguised as an asset, a condo with rising maintenance fees, falling values, and speculative buyers fleeing? Or do you want to own an asset that has been recognized as wealth for 5,000 years of human civilization? The ghost towers of Toronto are not homes. They are filing cabinets for bad debt. They are monuments to the hubris of believing that prices only go up, that leverage is free, that the music will never stop. But the music has stopped, the liquidity has drained, and the only question that matters now is, what are you holding when the tide completes its retreat? History favors the prepared, friends, and the window for preparation is closing. Not next year, not next month. Right now, as the appraisal gaps widen, as the receiverships multiply, as the convergence accelerates, the choice is yours, but choose wisely, because the market will not give you a second chance. Thank you for being here today.